Good afternoon. We'll go ahead and get started here at 2 o'clock. Thank you, everybody, for joining us for the first installment of our Landowner Insights series. I'm Dave Muth. I spend my time working in the capital markets group at People's Company. And we wanted to start to kick off this series to share some interesting trends and opportunities that we're seeing in the farmland asset class, and just have a chance to engage folks and help landowners understand how we might be able to help take advantage of these emerging opportunities. So today what we're going to do is talk a little bit just around how is farmland functioning, right? What are we seeing for returns, trends, some of the just recent run up that we've seen in values in certain parts of the country. What's that mean? And then we'll move into the discussion of a couple of interesting opportunities that we'll actually do a little bit deeper dive into in the next couple sessions on our Landowner Insights series here. So first off, let's just make sure everybody understands a little bit about People's Company. So two main themes that we want to emphasize: full service and national scale farmland transaction firm. So we have offices in all of the major ag regions in the country, really core philosophically. We believe farmland is still largely a kitchen table business, and it requires that boots on the ground with that local expertise and the ability to get integrated into those local networks in order to really understand opportunities around the asset class. So the primary services are the brokerage and auction service. Land management is working in over 24 states, managing farms now. Agricultural appraisal business is really important for us from a competitive intelligence standpoint, really understanding what's happening in different markets. Our capital markets group helps place capital for folks looking to get into farmland. And then the energy management business is a really interesting emerging business line, particularly on the renewables, along with some traditional oil and gas and mineral management capabilities as well. And then the ability to deliver crop insurance. So crop insurance is really fundamental to the farmland asset class, and we'll touch on that here briefly as we go through. A quick note, we'll have this recorded and available to share with the folks that are participating. And then I'll have some contact information at the end for folks that have any questions that they'd like to shoot over to me, and we'll work on getting those answered. Okay, so let's dive in and look a little bit at the farmland asset class to kick this off. If we go back and look at about the end of 2023, we're talking about roughly a $4 trillion asset class. So it's substantial. Now, a couple of interesting dynamics. The debt is incredibly low in farmland, down here at 13% roughly. It's a highly fragmented ownership group with a lot of legacy assets. That's a big reason for that low utilization of debt. And as folks know, we're a fairly low cap rate asset class. So supporting heavier debt loads can be challenging in farmland as well. That's another key characteristic driving that lower debt ratio. And also, thinking about it's a fairly inefficiently capitalized asset class as well. And that's where some interesting opportunities start to come. Returns are strong, right? So this is showing long-term returns over 30 years. The U.S. Ag 32 states is an aggregate of the 32 states that represent the vast majority of agricultural production and farmland within the U.S. And we're high single digits. And then we've lined up a number of states here that are high returning states, certainly. And we can see getting into double digits over this long term. And we've compared this with a handful of public equities there at the bottom. So a couple of takeaways. One, returns are competitive, and these are total returns. So we're talking about that annual cash yield plus that long-term appreciation. We're not correlated with public equities. We're tightly correlated with inflation, which we'll look a little bit closer at. And the core characteristic of farmland is the stability. Right? We just don't see a lot of negative returns in farmland, particularly compared with some of the public equities that folks can get into. So as an asset class, it performs really strong, particularly over 10-year plus windows. Here's another way to look at that What we've modeled here is $100,000 invested in farmland along with a handful of other equities. And we're looking at how this grows over long term since 1990. Two quick takeaways. Obviously, the growth of farmland value is substantially higher than the other equities. The other piece is you just don't see downward trends, right? You don't see the corrections when you're looking at farmland in the aggregate. That's really important to when folks are thinking about having farmland in an investment portfolio. One of the characteristics that's been pretty fundamental, and we've taken a lot of calls from people that have gotten interested in this over this last inflationary period. Farmland is the premier inflation hedge among real assets. If you look at the spread over CPI on farmland returns going all the way back to 1970 here, it's really quite amazing. And we're looking at roughly in the aggregate about a 6% spread over CPI. This characteristic is really fundamental, and it's a good reason why farmland has a home in a lot of investment portfolios. And we've seen the trend hold with the returns here over this latest inflationary period as we dive into some of this other data representing near-term returns. I like to talk through this long-term trend. So USDA has been tracking farmland values at the state level for about 53 years. Some states go back a little bit further than that. What gets interesting, if we look at an aggregate average annual return by state, and we're looking at the lower 48 states here, 46 out of those 48 states have a annual appreciation over this 50 plus year span between 5 and 7%. It's incredibly stable. There are certainly trends in different regions that are a little bit higher annual appreciation than other regions. And one that I like to point out is when we look at South Dakota, Minnesota, and Wisconsin up here, we see a slightly higher annual appreciation trend. This is largely attributable to the corn technology, right? We've expanded the corn belt moving further north and created additional value. But the stability across regions and over this long term, when we look at this map, I think is a really important item to communicate about farmland. Now, there's a flip side to that. Our cap rates, our annual returns are lower than a lot of other real assets, particularly in the core corn belt. We see some fairly low cap rates in the mid to upper 2% range. When we look at a state like Washington, this one's actually sort of difficult to lump into one number. That looks like a high cap rate at 7.9%, but the state of Washington is incredibly diverse, right? So we've got well over 100 crops produced there annually at scale, and we're lumping in returns from $100 an acre dryland wheat farms up to $70,000 an acre apple orchards all into a single number. So it's a little bit harder when we get into more diverse production like we see in Washington. But this is the core characteristics that we have to keep in mind when we look at farmland. One of the complicating factors with U.S. farmland is the diversity, right? So this is how we split the regions up across the country. And what we're representing here is the percentage of value by each of these regions. We can see the largest share by far is in the Midwest, and that's largely just sheer acres, right? We have so much production through those Midwest states. That doesn't mean that we're not interested in other regions. In fact, we're really excited about a lot of things going on in the Pacific Northwest and opportunities that exist up here, even though it's a little bit smaller percentage of the value. But the core reality here is that all of these regions have unique and diverse characteristics, and that's where it takes that local knowledge to be able to make sure that we're taking advantage of opportunities that exist. Looking at this a little bit differently, we're representing our top 10 production categories of crops, and we've got total value and acres lined up side by side here. Corn and soybeans dominate both in terms of value and acres. And then third in value is our fruit and tree nut category, but we can see acres are substantially smaller. And we start to move down this line. All of these crops, all of these top production categories represent really interesting opportunities, but they're also very unique production systems that we have to be able to understand the dynamics in order to manage and acquire effectively. One more core characteristic on farmland to point out, the economic fundamentals at the baseline level are strong, right? If we think about what's happening globally, certainly everybody understands population growth in certain regions. But if we look at how wealth is growing in some of our more populated areas, think in Southeast Asia primarily, that's where the type of calories that people consume are going up. Once we hit that middle class income level, the consumption of animal protein goes up substantially. This is a positive story net for U.S. agriculture, particularly in the feed grain side. So we see good global fundamentals driving for the asset class as well. Now, one of the most important things about the U.S. farmland asset class is the federal crop insurance program. To our knowledge, U.S. farmland is the only investment grade asset class on the planet where there's a minimum annual revenue guarantee from a federally subsidized insurance program. That sounds kind of staggering, but that is functionally what the crop insurance program does for us. It's well over 90% of the 300 million farmed acres in the U.S. are insured under the federal crop insurance program, and the vast majority of those policy structures create a minimum annual revenue guarantee for operations. This is a truly stabilizing mechanism for cash flow on farmland and subsequently the returns back to land. This has really been powerful, and it's a big part of what we're doing when we look at assets going forward. So let's talk just a little bit quick about what's been happening and what are the dynamics in the asset class. So 2023 farmland values, and I would refer folks to our National Land Values report that you can download at peoplescompany.com for a little bit deeper dive looking regionally what's been happening with farmland values. It's a really great document to give a little bit more background and a little bit more depth behind some of these year-on-year trends by region. We've seen a significant run, and so the core Corn Belt is holding values and pushing forward. California still is showing up as the highest value, and again, I'd point out that when we look at a state like Washington here at $3,000 an acre, that's a challenging one to aggregate to a single number, considering that variability across from dryland wheat ground selling maybe $800 or $1,000 an acre to those $70,000 an acre apple orchards. The total returns for 2023 are slightly down in the I states, or at least Iowa and Illinois from previous years, and we'll look at that. They've maintained strong annual returns. Again, this is a total, that rental return, cash yield, plus the appreciation through the Plains states. Generally speaking, across the country, we've seen really strong returns, and this fits with that inflation hedge theme as we've continued to see the tail end of, hopefully the tail end of an inflationary period. So let's look at this both on a 1-year increase and a 3-year increase from a value standpoint. We can see these Plains states really did have a pretty substantial run. Throughout the Midwest region, we saw substantial increases. And when we move to a 3-year look, we really do see some pretty significant runs in farmland values. And that is consistent with a lot of folks' intuition and just what we've seen in the marketplace anecdotally. It's fairly easy to explain how we got here. So if we take ourselves back to that run in farmland that we saw in that 2011 to 2013 range, a lot of that was driven by the high commodity price cycle that we saw. We came off of that run and we had about a 5-year lull, maybe a little bit more in our core commodity prices. And farmland values just kind of moved along at slight increases, generally speaking, around the country. And then if we remember a trade war with China, and that kicked off some subsidy programs, the market facilitation program, specifically MFP. We had versions 1 and 2, and that kicked out ad hoc subsidies government printed money and put it directly into farmers' checking accounts. So we got through that program, and then we moved into CFAP, Coronavirus Food Assistance Program. There's 3 rounds of that. The first 2 were the most significant. In similar sort of outcome in terms of pushing money directly into farmers' checking accounts. When we look at those programs in the aggregate, there's about $54 billion that was pushed out into farmers' checking accounts, just as an ad hoc subsidy. Quick note on that, about 5.3 billion of that just came to the state of Iowa alone. For context, in an average year, that's more cash than the value of land that transacts. So this is really substantial. We had a lot of cash in the system. We saw this across sectors. It's not unique just to farmland. We also, in this cycle, had a uniquely timed commodity price run. It was fairly late in the year, so lease rates and a lot of crop inputs, et cetera, were already bought for the next year. It created a dynamic for a really high net income year. At the front edge of this run, we still had very low interest rates. And so essentially free money to be able to leverage up. And we had a lot of investor interest too, right? Just asset cap rate compression across the board made farmland look a little bit more attractive from a cap rate standpoint. When we put all of this together, it created a bit of a perfect storm, and that's really kicked off what's been a pretty strong 3-year run. So here's our total returns by state over this 3-year period. And these are substantial and fit really nicely with that historical inflation curve, right? That spread over CPI. Now, where's that put us? There's a lot going on in this, but what we've mapped here is a long-term 30-year trend line by region. And then when we look at this, what we see is pretty much every region is slightly above trend line as we sit here right now. Okay, not substantially in any case, but we have moved and caught up and actually gone past trend lines. So this run that we've seen with inflation has sort of got us back into that historical performance of farmland where we were kind of in a lull there for a number of years following that last run. One of the questions that we get a lot is, okay, well, if we're a little bit above trend line, what does that mean? Should we really be trying to buy farmland right now? And one of the best quotes we've heard from a investor, a big investor in farmland, is the right time to buy farmland is when it's available to buy, right? And the data sort of shows that as well. Okay, when we look at long-term trends in farmland, if the intention is to hold it into that 10-year plus sort of time horizon, it really doesn't matter when you get in. You've got to be able to find the assets when they're available. And this latest run has actually brought quite a bit of farmland to the market that may not have come to the market otherwise. So professional investors have been pretty excited to be able to get access to quality assets that they may not have seen otherwise. And the core story here is that the acquisition timing within our asset class is less important. It's more about being able to identify and take advantage of deal flow that's available. And this little table kind of spells that out, right? So farmland turns over something in the range of 1% to 2% annually. That's where it gets challenging, right? And it goes back to that fragmented ownership. And we have to have the infrastructure in place to be able to take advantage of that when it's available and understand how to leverage those opportunities. So that's a quick snapshot on where we're at with the asset class now, broadly speaking. Let's talk just a little bit about some of the drivers and opportunities that we're pretty interested in. This notion of financialization is an important one, right? The demographics are pretty clear in farmland. It's over 80% of principal farmland owners are 55 or older. About half of those are 75 or older. And this sort of demographic trend has been there for quite a while, right? There's been a lot of conversation about aging farmland owners and aging farmers, certainly as well, for a couple decades now. And what's been interesting is there's just sort of a constant cycling across that demographic chart when you look at it. Folks will leave the assets to their heirs, taking advantage of stepped up basis and deferring capital gains. In that trend we're starting to see some evidence that trend is breaking just a little bit, right? We're multiple generations away from the farm, so we'll see some of the farmland owners perhaps dispose of assets even before passing away and grabbing that stepped up basis for their heirs. Or we'll see the heirs want to actually take advantage of the cash rather than holding onto the assets. So we're starting to see some signals where the assets, the trends from a demographic standpoint are shifting a little bit versus the cycle we've been in for many, many generations. And then just the broad investor interest in sort of institutionalizing the asset class and rolling up and creating opportunities for vertical integration. This is a trend that we're seeing happen in some regions more than others, but just broadly across the asset class that creates some pretty interesting opportunities. The consumer side of the equation is pretty interesting as well. What we're really talking about here is this combination of finding additional value in the marketplace, as well as just maintaining market access. So consumers are making more demands of their supply chains, where their food comes from. And they're thinking about drivers that can include the type of production system, the carbon intensity. These can create pressures and opportunities. We're really focused on maintaining a pathway to see long-term market access, right? Meeting the needs of the supply chain where we're maintaining market access, and then certainly finding value-added opportunities where they emerge. The technology story, it's really simple in terms of the appreciation side of the technology story. We just continue to produce more with less. Right, that's a big piece of what's happening with farmland appreciation over the decades that we've seen. We're also really interested in the last 10 to 20 years of development and technology for landowners. And that's one of the first themes that we're going to dig into just a little bit further, and even more so in a future Insights webinar. And then the story of expanding revenue. We see a pathway looking ahead over the next 20 to 30 years where a significant share of the revenue from owning land in general and farmland specifically is going to come from beyond just agricultural production. And we'll talk about one case there and sort of tee up a little bit of a deeper dive at a later point in time also. So thinking about the technology for landowners kind of theme that we're really excited about and interested in, we're delivering and building out an Insights data toolkit. We have a first version of this available on the People's Company websites. We call it the Farmland Insights page. We'd invite folks to come and keep an eye on this. We're continuing to add more and more data and more tools for the public to be able to engage a lot of these data resources that we're working hard on making sure that we keep in our back pocket to understand the asset class. What we're looking at is a range of scales, right? National, state, and county, and long-term data. In being able to interact with farmland values, again, over time and down to that county level, farmland returns, both on the rental rate and the appreciation side. We've got great yield data that USDA has been procuring and managing over the long term. And then soils data. How do we, when we're looking at individual assets, how does that play and how does that compare to neighboring assets and neighboring counties in the state, and then more broadly at a national level? And then one of the things that we're really excited about being able to roll out is the crop insurance trends. When we're looking at the actuarial underwriting around crop insurance, that paints a really clear picture, right? Because we're getting into those baseline productivity trends that are tracked really closely to understand where we have opportunities to continue to get more and more productivity. So these tools are out and available, and we're continuing to roll additional data resources and additional widgets and calculators to help folks kind of interact with different areas, different counties, thinking about getting data about assets that they may like or currently own. And then when we take this to the next level, we built out a pretty substantial framework, integrating a lot of great tools that have been released in the marketplace for how we actually evaluate assets. And this is where we'll dive into how we can use these data resources to really understand opportunities around an asset here in a future webinar. We call this our FarmWorth tool. And if you look at what's happened in farmland data resources over the last 20 years, it's pretty substantial. If you go back even 20 years ago, in a lot of cases, to get a soil map for an asset, you were having to go down to the county NRCS office and get a printout map. And what we're able to do now is actually pull in just massive amounts of data looking at individual assets. We can understand all of the ownership history with data resources built upon aggregating county assessor data. We can understand what are the FSA boundaries around tillable. Obviously, the soil's topography, crop history, thinking about floodplains, being able to pull in fairly high resolution weather data. On top of that, we can get into wetlands and opportunity zones, another really interesting opportunity that we'll explore at another time in another webinar. And then aggregate that with a lot of the insights data that we just talked about, and we can start to get context around how an asset fits in with that broader picture. What we're doing internally with our FarmWorth framework is actually getting all of the assets we work on mapped through the system. So now we get a really collaborative view across our business units and understanding what's happening on different assets and how can we get more information when work has been done on individual assets. And then we have a really robust sort of venture capital funded environment right now where there's a number of good companies building additional tools. And we've created a framework where we can partner and integrate those sorts of data resources within our toolkit in order to accelerate that ability to understand value on an asset. And comparable sales is a really interesting one right now. We have the ability to pull in acres and camo. Two applications that you've likely heard of that are focused on building out robust comparable sales databases. And we can start to see what's been happening over the last month, 6 months, 1 year, 2 years around an individual asset from a comparable sales standpoint. That's truly powerful. And then one of the things, and we'll talk about this just a little bit more here in a second, that gets really powerful is starting to understand how the infrastructure that's going to be a growing opportunity for farmland is aligned with an individual asset. So we're thinking about transmission lines and substations, where there are existing renewable energy production opportunities. All of these resources are now at a landowner's fingertips to be able to really quickly identify both how to look at an asset they may be considering purchasing, how to look at their own asset, and think about the opportunities that they may want to take advantage of. And so our next Insights webinar, we'll dive in with a couple of live examples on how we're using these data resources to create a really strong information flow and understanding opportunity within individual assets. I want to flip now and talk quick about this notion of expanding revenue. We see this as a multifaceted opportunity. What I want to focus on here that we put quite a bit of energy over the last couple of years understanding is this notion of net zero and how that impacts farmland. And at the top level, when we think about the net zero goals, and even more broadly, how has agriculture and farmland been looked at relative to carbon intensity in a lot of the climate change discussion? For a long time, agriculture was a problem. And we have seen this shift where farmland and land in general is now seen as a really important part of the solution. And this is where some really interesting opportunities are emerging. Now, we're not saying that a lot of these subsidy programs, a lot of the goal structures that we're going to drive and hit all of these. We're not saying that the massive spend on a lot of these programs is or isn't the right thing to do. What we are doing is recognizing some trends and making sure that we're helping landowners be positioned to take advantage of them as they emerge. If we look at what's happened here over the last several years, we're up over $1 trillion a year globally in investment into this energy transition, this low carbon energy transition. Bloomberg NEF is a data resource I like to keep an eye on. If you look at what needs to happen in order to hit goals in 2030, 2035, and then out to 2050, this actually has to average over the rest of this decade about $4.3 trillion globally. And a lot of this investment has been public investment, but we're seeing a really sharp trend with private investment coming along behind. And this is where there's some chaos out there, but there's also some interesting opportunity. So let's just highlight, and I'm going to go over on a high level what the opportunity can look like in this sort of net zero trend. And this is another one where we'll use a insights webinar session to dive in really deep and get into the tighter story on this. There's two elements that impact farmland. One is the low carbon energy transition. So that really means getting our energy from sources other than fossil fuels. And then the other piece is carbon storage, right? And farmland, it has a pretty unique opportunity there as well. Let's start to think about wind production. And I like this example because it gets your attention from a visual standpoint. Now, we need a scenario to be able to project how this will actually roll out when we think about 2050 net zero goals. And so we've referenced some base cases from the Princeton Net Zero America study in order to create these forecasts, right? The sort of summary of what would need to happen to hit these base cases. Again, not saying that this is exactly how it will emerge. We're just highlighting and characterizing an opportunity. So for folks that have driven across Iowa going up and down I-35 or across Interstate 80, it doesn't feel like you go very far past one wind farm before you see the next, if you go any distance at all. What we've got right now is about 6,300 wind turbines in the state of Iowa. Okay, so each turbine in this picture represents 100. Okay. Now, if we project forward on the Princeton Net Zero base case, Iowa would need almost 48,000 wind turbines. So this is our representation visually. And now this starts to give some context on just how intense this process would be and how much revenue we could be looking at for landowners. If we take some simple assumptions projecting forward in terms of how much electricity we're going to generate per wind turbine, what the lease rates are going to be, and start to lay that out by state against these projections on how much we need, we see some substantial revenues. There's several states that are close to or even over $1 billion a year in additional revenue to landowners. So this is really substantial and really impactful in thinking about farmland values. The solar story is a little bit different, right? Because when we're talking about solar on farmland, we're talking about a fundamental land use change. And there's a pretty clean argument that good, high quality farmland probably isn't the highest best use in solar. Now, we see when we look at this, the solar resources are often in places where you're not necessarily intersecting with that good, high quality farmland. And it's an opportunity to think about potentially lower productivity land, creating additional revenue. But generally speaking, there's a lot of opportunity in the solar arena as well. The biofuel story is an interesting one to me. If we look at the current production capacity of biofuels, it's a little short of about 23 billion gallons a year. The biggest production is in Iowa, and it's driven largely by ethanol, right, in that range of 17 to 18 billion gallons. And there's a lot of concern about the electric vehicle push reducing the need and the demand for ethanol. When we start to look at what needs to happen in order to hit some of these net zero outcomes, we need a lot of what's called sustainable aviation fuel. 16 billion gallons likely to increase as we move towards 2050. And ethanol is actually a really good hydrocarbon, and we're seeing some at-scale projects now upgrading ethanol into sustainable aviation fuel, SAF. And the renewable diesel story is really substantial, well over double the existing capacity of biofuels needed in renewable diesel in order to hit these 2050 net zero goals. And just a little bit of an example, if we kind of think about soybeans as the feedstock, not saying that this is exactly how this will merge, but just to fill that gap, we need about 24 billion bushels of soybeans. And current annual production is about 4.5 billion bushels, right? We're talking about a substantial additional feedstock need from farmland production in order to hit the renewable fuel goals in the aggregate, as opposed to a negative trend just in the ethanol EV story that we're talking about. So we see biofuels as another really interesting opportunity. The soil carbon story is super interesting. Soil carbon storage has been challenging, right? We've got a couple of issues. We've seen highly discounted values on carbon that's stored in farmland soils. There's two reasons for that. One is additionality, the other is permanence, right? How much are we really adding versus what was there before? And then we have the reality that on farmland soils, soil carbon that's built up over time can be released with aggressive tillage or other kinds of practices. That's created a bit of a discount factor. But when we do some biogeochemistry modeling and look at what we actually can feasibly store in our farmland soils, and we think about what could be a rationalized price in the $50 a ton range, again, we see states getting up to or even over $1 billion a year in additional revenue back to the farmland within each state. This is another one that's substantially impactful as we look forward. When we put all of this additional revenue together, again, just kind of characterizing the opportunity, we're talking about over a $400 billion impact in farmland values looking out to 2050. And the key is we have the ability and the business models are emerging on how we can start to take advantage of this. And we want to make sure that landowners understand and have the resources needed to be able to participate as these investments continue to emerge. So how do we take advantage on these revenue opportunities? One of the big pieces, and this comes back to the data story and spending our time being integrated into sort of these development processes. First, we need to be able to evaluate the opportunities. This is a simple graphic with a couple of farms with wind farms overlaid, the transmission lines, and where the substations are at. And you start to think about that streamlined pathway to development. You maintain the relationships with the developers, and now you can get them engaged if you are interested in seeing some of these revenue opportunities emerge. And then you have to get into the process of actually negotiating agreements. And this is what we want to talk about in a future webinar as part of the series, is getting into a little bit more detail on how we can go about doing this and how does the data really emerge and the opportunities sort of pop out. All of these resources are at our fingertips now, and that's a pretty exciting outcome that we can chase. So I want to thank everybody for joining us. Hopefully there is some valuable information. As I mentioned, the webinar is being recorded, and we'll be able to distribute that so people can reference back. And if there's any questions that popped up, feel free to shoot me an email at dave.muth@peoplescompany.com, and we will make sure and address it. Appreciate it, and we'll look forward to catching people on our next webinar in the series. Thanks much.